Good afternoon. My name is Bruce Bolger. Thank you for joining the Enterprise Engagement Alliance Zoom shows, in which we feature experts from all over the world in all areas of human capital management, marketing, and finance to discuss some of the most pressing issues today about the management of people. And the Enterprise Engagement Alliance is an outreach and education and certification organization that promotes a strategic and systematic approach to managing all stakeholders, all people. So we're very lucky today to have with us some real leaders in their respective areas to address some of these issues with. And we'll start with Amy Armitage, who's chair of the Human Capital Investment and Reporting Council program, and director of the of the Conference Board. And she's got a growing network of human capital metrics experts. We have Sonia Consiglio Favaretto, excuse my Portuguese, it's a little rusty, Sonia. And she's pioneered chair of the Global Reporting Initiative, the Brazil Advisory Board. And she has many credentials here we don't have time to go through. And that's similar with Alex Edmans, a professor of finance, London Business School, author of Grow the Pie, which is a terrific book I highly recommend. It is the Bible for stakeholder capitalists on how to grow a society through a prosperous capitalism. And then Laura Queen, she is CEO of 29 Bison. They're one of the first human capital advisory companies specializing on helping mergers and acquisition organizations make better decisions by better assessing human capital. So she's got really one of the most cutting edge companies of her sort in the US. And also 3 of the 4 people on the phone have extensive background on human resources. So they're going to be talking and helping us talk about the positioning of this whole issue for management and human resources or marketing or sales. And of course, with Alex Edmans, we have the whole issue of finance being addressed because that's the angle he comes at it with. So I'd like to get started first. So I'll start alphabetically on this one. To what extent, Amy, do you believe that in the US, we'll speak for the US at this point, maybe Alex can give us perspective of the UK and European Union. To what extent do you think CEOs are grasping the importance of a strategic and systematic approach to how they manage people and also the managing their metrics and scorecards?
Yeah, it's a great question, Bruce, and thank you. And I think the obvious answer in the U.S. is really very few. But I think, at least in my council, the members are all trying to really figure out what stakeholder capitalism means. It has, as you suggested, various meanings. And we've been trying to understand, what do we need to do more of and what do we need to do less of? And certainly what we've focused on is the more of in the way of outcome measures, particularly social and economic outcome measures, and being able to improve our members' ability to measure outcomes, and in particular, the human capital and social contribution that's needed to get those outcomes.
Well, we're going to talk about that definition with Alex, because he and I have had some discussion about that. Laura, what's your viewpoint on the general acceptance of the need to have a strategic and systematic approach? And stakeholder capitalism is one element of this, but more practically, that's sort of the philosophical thing, but more practically, we run businesses and we need to achieve better and outperform our competitors. So to what extent have organizations really recognized, Laura, to your view, that people really is their number one asset?
That's a great question. And I agree with Amy. I think certainly fewer organizations than we would like to see. I believe, with relatively few exception, that most business leaders, whether they're private or publicly traded organizations, truly believe or have the intention that people are their most important asset. I think we struggle, particularly in the United States, with an accountancy system that flies in the face of looking at all intangible assets in a meaningful way and being able to report on them like you would like human capital to be reported on as part of the material KPIs for an organization. and certainly I imagine that all four of us are here to begin changing some of that, that accounting for businesses.
Well, that's a great segue to you, Alex, on multiple fronts, and then also to you, Sonia, in a second. Alex, answering that question about your view about the degree to which CEOs get this, get a strategic approach and the logic of grow the pie.
Yeah, so I'm actually going to present a more positive viewpoint on this, is that I do think there's a positive direction of travel. Now, part of this could just be a selection bias, is that the CEOs and the executive and the investors who I talk to are the ones that naturally understand the importance of treating stakeholders well. But when I started my career as a professor at Wharton 13 years ago, when I went to an initial responsible investor conferences, there were not mainstream investors who were there. So they were purely socially responsible investors whose goal was not just to make a financial return, but also a social return. But now what's interesting is even mainstream investors, that their only goal is financial returns, they're viewing something as human capital as being important. I think investors are important because investors drive what executives care about. So there's one leading investor in the UK, and she asks CEOs, tell me about your people. What are their challenges and how are you trying to address them? And there will be some CEOs who will say, well, next time I would bring my HR director if you were to ask me about their people. And that's clearly a bad answer, and others will actually tell them the answer. So that, because investors do want to ask that question, that suggests that they're viewing it as material, and therefore I see there being movement in the positive direction in terms of executives. Could it be faster? Absolutely. I fully agree with Amy and Laura that this could be faster, but I do see there being progress in that direction, although it's not as fast as we would like.
Well, that's great news. Sonia, from your perspective, we're big believers that companies should be disclosing this information in their corporate responsibility reports. To what extent, and I see in the US very few companies doing that, not even 1%, and most that do, it's shabby. I hear that Bank of America has just released a wonderful one, Merck, SAP. What's your view of do companies beginning to get to Alex's point that they need to publish information that investors and potentially customers and employees want?
Yeah, thank you, Bruce. First of all, thank you for the invitation. A pleasure to be here with you. First of all, I agree with Amy, Laura, and Alex about the value of intangible nowadays, more and more, and about the focus from investors. I think the investors is a key stakeholder this game, and you are asking me about the transparency, and the transparency is the name of the game, and we are seeing this during this pandemic, how the stakeholders, all the stakeholders are asking for more and more information to understand how the companies are dealing with all the challenges. So the transparency is crucial, and one thing I believe it's important to put, it's have a reporting, to have a disclosure information with financial and non-financial information together. I think this is a very important point when you talk about the disclosure, because sometimes the companies do the financial disclosure first, for example, in February during their presentations, and only the disclosure about the ESG information in May, in June, some months later, and nobody read, just us, sustainability experts. So transparency is crucial. We need to increase this practice. From my point of view, from the GRI point of view, this movement is increasing more and more. I can mention one data only. For example, GRI is the most widely adopted global standards for sustainability report nowadays, we know, and 75% of the largest 250 companies in the world by revenue use GRI. So you can affirm that more and more companies are disclosing the information. But again, to put financial and non-financial information is definitely important in this movement.
Laura, from your standpoint, you got your company, you started boldly about 2 or 3 years ago with this notion that investors would begin to value the necessity of understanding the 80% of the balance sheet, which is in no way really accounted for. What degree of progress are you seeing it where Alex is, that it's beginning, that there's a percentage? Because I agree with Alex. I think I think that's right. And it's coming, as Sonia said, from investors. I think that's ironically where the ESG investors, Larry Fink, Paul Tudor Jones, and we'll get to that definition of stakeholder capitalism with Alex in a minute. Laura, but your standpoint from investors or M&A people, or again, it's probably only 20% that get it.
We're seeing a significant uptick. It was a very difficult conversation for us to have, particularly in the private equity community 3 or 4 years ago, and that represents about 70% of our customer population. What we are finding these days is particularly organizations that have an interest in working with and growing businesses, portfolio companies specifically, who are really focused on people as a significant portion of their operation. Life sciences companies, bio companies, consumer retail organizations, a number of call center focused kinds of organizations, and certainly technology services companies very much are looking at understanding and uncovering the value that gets created or is potentially lost, both through the due diligence period in the organization life cycle, the investment life cycle, but even more so during the growth period. And they're looking across the board, everything from very traditional tactical kinds of issues, things that are more HR compliance related, and more. As a matter of fact, we just closed a deal that was significantly focused on understanding what the trajectory of succession looked like in this business as they were creating a platform to acquire, to do bolt-on acquisition with, through a growth cycle that is probably going to be about 10 years. It's a sustainable energy company, but understanding very specifically what their people were looking for as part of their employment understanding with this organization, such that the investor would be able to increase the growth trajectory of this business, focused very much on what were opportunities for some of these individuals, understanding things like individual growth orientation, ways for them to learn and to contribute in an area of society, in this particular case, sustainable energy, that was near and dear to the principal business owners' hearts. And we had the pleasure of being with them alongside that exploration, which is huge in terms of the level of interest and understanding from an investment community perspective.
We're going to have time today to get into some of the brass tacks of implementation here, and how to get the CEOs to really begin to focus that this isn't a bright, shiny object. That's the problem. Mm-hmm. But before we do that, I want to get into this discussion about stakeholder capitalism, because it is important, because the people who are espousing it are actually big investors. Larry Fink is a great example. Paul Tudor Jones, as I said, Just Capital. Klaus Schwab, he's not an investor, but he's certainly a pretty well-known person and very influential. But there's been a lot of debate about it. And the way we define it, there shouldn't be any debate. But Alex, you've had an opportunity to kind of study stakeholder capitalism. Could you give us your views on sort of the debate and the definitions? Because folks, there's no definition. If you go online, there are two definitions, one from my organization, one from Investopedia. Now, which one is more prestigious? So Alex, what's your perspective on a term that people are espousing without even having defined?
Thanks, Bruce. So I'll start with where there is agreement. So there's agreement that stakeholder capitalism, as the name suggests, is a form of business that takes stakeholders seriously. But where there's disagreement is the link between that and shareholders. So some people, at least implicitly, think that stakeholder capitalism is anti-shareholder capitalism. So their way of implementing it is through sort of changing corporate law to reduce shareholder primacy, maybe reducing voting rights, or maybe putting workers on the board. So that views the value that a company produces as a fixed pie, and the only way to give a greater slice of that pie to stakeholders is to reduce slices from shareholders. But instead, my view, and I believe that this might also be your view, Bruce, is actually stakeholder capitalism can also be consistent with generating long-term shareholder value. Now, the key word here is long term, because in the short term, yes, investing in your stakeholders does reduce your profits, but the work that I and others have done has shown that, well, in the long term, if you're taking stakeholders seriously, then you will actually improve long-term shareholder returns. And that's consistent with, I think, some things that my fellow panelists have suggested, is that investors are sometimes the driving force from this new model, because it's not an either-or thing. At least in the long term, there might be a way of improving both stakeholder and shareholder value. So what does that suggest? Is that actually investors might be part of the solution rather than part of the problem. Is not that we want to disenfranchise investors. It's not that all investors are good, right? There's some good and there's some bad investors, but what we'd like is investors which take large stakes in companies, which are willing to look beyond short-term earnings and assess human capital, just as my fellow panelists have highlighted. So what we want is the right type of shareholder, the ones that are willing to get into the weeds of the organization and understand the intangible assets, not just stuff that you can plug into cell C23 of a spreadsheet.
Well, Sonia, this ties into some of your work. I follow you on LinkedIn, and I think, excuse me, there's a blur of acronyms out there, but I think you published something you called EESG. Could you tell us a little about that perspective? Because I think it relates to this.
Yeah, definitely related to this, Bruce. Yeah, I think the key point is to put all the factors together. You know, it's quite traditional to say about ESG factors, environmental, social, and governance factors, and it's okay. But the article that I published and what I'm proposing is to put another E together, E from the economic. So economic, environmental, social, and governance together, because we are talking about to create a new world, new economic, new way to produce, to behavior. So see, if you continue to talk only about ESG, separately from the financial world, we will continue to work in a parallel world. So the article that I publish, and I'm talking more and more about ESG, and in other words about this new perspective of the economy and the world. And you know, I really enjoy the approach that Alex mentioned about the short term and long term, because I think this is a very important perspective on this discussion, because sometimes the people say, oh, sustainability and ESG factors are important, but only in the long term. So if it's right, in the short term, I want to see this thing. So I would like to mention a very interesting survey from McKinsey & Company. They published it last February. It is an online research from July last year. And the idea is to bring the perceptions from CEOs and professionals from the community, investment community. And they try to see if the perception from these professionals have changed in the last 10 years about the short term and long term, about how ESG programs create value in short term and long term. And the results are quite interesting, because all the perceptions from CEOs and from professionals, the investment community, said that in the short term, ESG factors are creating more value now in 2019, I mean, than in 2009. So the idea, in my opinion, and what you need to do and to improve is to put all things together and to think now, short term and long term, about the value creation onto this thing.
So Amy, let's get into a little bit into the weeds with human capital analytics. One of my, you know, when I hear about all these human capital analytics, it seems so abstract in many ways, right? Human capital analytics, human capital reporting. What does this really mean? How is it relevant to my business? And I think ISO 30414, that for those of you who aren't aware, is a new standard from ISO, the International Organization for Standardization, that essentially lays out a framework for a strategic and systematic approach to reporting on human capital. Now, it's a voluntary standard, and it's gotten almost no pickup in HR. We'll talk about that. We'll have time to talk about that today as to why, but none of the HR communities are talking about any of this, I would argue. They talk about the future of work all the time, but no one's talking about this. So Amy, my question to you is, getting down to the granular thing, how many companies do you think have a scorecard where the CEO could say to you, I could say to the CEO, what's your revenue per customer? What is your turnover rate per customer? What is your customer's willingness to refer? And then the same thing with my employees. What's my turnover rate? Oh, what are my accidents? How many accidents have I had? How many lawsuits? How many CEOs do you think really have their fingers on the pulse of a scorecard of ratios that are relevant to potentially continuous improvement?
Well, it's a good question, Bruce, and I think, what we have seen is, the last 2 decades have really been the decade of the scorecard. I think there are a lot of scorecards out there, there are a lot of measurements out there, but as you suggested, sometimes those measures aren't the ones that really drive business impact. And I don't think they address what the CEO oftentimes needs to connect to a scorecard, which is what's the business problem they're trying to have. Now, what's happened with COVID-19 is you've seen a new spotlight on social and human capital, because the CEO is now saying, what do my people need to do? What do my customers need to do to recover? And what do we have to do to really align recovery with our business model? So all of a sudden, what I'm hearing from my council members is the CEO wants to hear about what's happening with recruiting. They want to hear about closing critical skill gaps. They want to hear about how we're going to build the capabilities with digital transformation, with a rapid move to AI and automation. So I think that the scorecard per se probably isn't as important as the conversations that I'm seeing our members having about measurement, about movement, about some of these key critical metrics, many of them coming from the ISO standards, that are important to business recovery and the business model. So it's our responsibility to connect the metrics to the story, particularly about recovery and economic business success.
Well, that leads to a great question for all of you. And I'll just go clockwise here. Sonia, to what extent do you think COVID will accelerate or decelerate this focus on a more strategic approach to managing our relationships with our employees and customers and other stakeholders?
Bruce, definitely. I think the coronavirus crisis, of course, it's a big tragedy, but it's giving us a huge opportunity to enhance this social agenda, environmental agenda, the ESG agenda again. I think, and why I believe in this, because this crisis is completely different from the 2008 crisis, for example. Now it's a crisis that has the human factor in the essence. It's essentially a human crisis. So everybody is living with this effects. So I think the nature of the crisis will drive definitely the focus on the ESG and the human capital and so on. And we are hearing so many, and we are seeing so many signals from the investor community, from the government, from the consumers talking about this. There is me again with the research. Sorry, I'm a journalist and I love data. So that's why I will mention some of them during my speech. And one that I really like is one made by Edmans with about 12,000 consumers in 12 countries, Brazil included. And it is a survey about the brand and about the fidelity the consumers to the brands in this moment. And the survey showed that 71% stated that brands and companies that put their profits before people, this moment, will lose their credibility forever. So I think the coronavirus, again, it's a tragedy, but it's a huge opportunity to turn, it's a turning point, in fact, in my opinion.
So I'm going to get to you in a second on this as well, Amy, because you did touch on it. But Laura, what do you think? And what do you think?
I agree with both Sonia and Amy brings up a really good point. I think both in light of the COVID circumstance, but also certainly in the United States, and now we're seeing it around the world, the racial justice issues that are being raised really create a necessity for organizations to take a different and perhaps a deeper look at the numbers that are being reflected in their employment environment, right? Some of those are diversity and inclusion circumstances. Some of those are other things. As you've suggested, Bruce, they are safety circumstances, certainly customer and consumer impacts. But I think Amy raises a really important point here, which is making sure that scorecards and human capital measures, and certainly to Sonia's point, broader ESG measures, are understood in light of the materiality for the individual business. It's not just adopting a set of universal standards. Where I think the standards are really important is in the quantification aspect. I think understanding which of those individual material aspects are important for a business to understand how they operate, what their value is internally to their internal stakeholders, and what their value and importance in creating greater institutional, organizational value, but also social value is to the communities that they serve, to the other stakeholders that are a part of that community, is incredibly important. And I think this particular time in our experience sheds a light on all of those things in a way that is certainly tragic, but we couldn't have created otherwise. And it gives us all an opportunity to rethink this position.
So Amy, you think this is a sort of a flash in the pan that we're all going to be shaken up like September 11 and then, you know, go back to our ways? Or do you think this is something that's going to stick?
Wow, I think everybody's asking that question right now, Bruce. I think those of us that are optimists think that spotlight is not going to go away. That organizations like Just Capital that put the spotlight on health and safety and then start ranking the top 300 companies in the United States, those kinds of metrics aren't going to go away. That kind of flashlight is also affecting a generation of millennials who want more transparency, they want more openness, they want more purpose, they want more social connection to the companies that they're dedicating lives to. So I don't think it's going to go away, because once you sort of open this box, call it the Pandora's box, I think people will demand the transparency.
Well,
certainly investors already are.
Well, and what's interesting, and turn this to Alex now, I just recently saw that one of the reasons the stock market is doing so well is that there's been a flood, and I don't know whether this is happening in Brazil or in Great Britain, but there's been a flood of individual investors. Like my son, he's 28. He's actively in the market right now. I mean, I'm not getting it from my son. It's well known that there's been a flood of people of all ages investing. So, and 70% of people in a Just Capital survey with Harris, in a poll of 2,000 people, said that they are making decisions about investing, about who they want to do business with, and who they want to work for, based on their focus on people and the environment as well. So Alex, you come at this from this, as I've said before, Alex is a professor of finance. He's done some original research on stock price performance that's covered in Grow the Pie, and I'm going to give you a chance to tell us a little bit more about Grow the Pie. But first, Alex, tell me what your view is. This something that you think, you deal with hard-nosed CFOs. I mean, we hear that CFOs now really view that human capital as an issue. And in fact, the EEA we're going to be developing a certification and learning program for CFOs, but I have no idea how many people will be interested. What's your view, Alex, do CFOs now see this? Is this going to stick?
I think so. So I agree with all my fellow panelists that it's not just a flash in the pan, because even before the pandemic, there was a big trend towards hearing about stakeholders. So whether you saw this in the Occupy movements or in Extinction Rebellion and so on, we knew that there are big global problems and that businesses need to solve these global problems rather than just focus on short-term profit with scant attention to this. So part of the reason is the magnitude of social problems, but part of the reason is also the recognition that what was referred to as non-financial factors are actually financial factors in the long term. So that's why I completely agree with Sonia's idea that these things should not be separated out, because everything is ultimately financial in the long term. So I do believe that even hard-nosed CFOs are getting it. And when I often speak at these conferences, I'm introduced as a professor of finance, and the audience gives a double take because they think, well, the finance department is often the enemy of human capital and purpose, thinking, well, that this is just a waste of money. But any CFO with that mindset is not doing his or her job properly. So I think it is the increasing recognition that these things are financially material. backed by, in part, investors recognizing these are financial material, which is positive. So just one little anecdote is I serve on the Responsible Investment Advisory Committee for Royal London Asset Management, which runs 5 sustainable funds. But who attends our meetings? It's not just the head of sustainable investment and the head of responsible investment, it's the chief investment officer. So the CEO is responsible for every fund, not just the sustainable funds, but he recognizes that the analysis of ESG factors, or is ESG, it's economic as well. And so that's why he thinks he can take the insights of those meetings and apply those to his other funds.
No, it's interesting. Morningstar did a study, and Harvard Business School did a very interesting study using different methodologies that have found that ESG-oriented companies have done much better since the pandemic than the markets at large. In fact, Harvard used a very interesting methodology, artificial intelligence. They did word clusters of what people were saying about companies, and then they took those word clusters and applied it to their stock prices. So it's sort of like Just Capital uses a similar type of methodology of finding out what's important to people and then tracking company based on that.
Right, but I just be a little bit careful of that, because anything like ESG, there is confirmation bias, right? We would like to believe that companies that are good to workers and good to society outperform in the long term. So people have latched onto these Harvard studies and saying, look, they've done well in the crisis. But let's say they'd found the opposite, right? Had they found that employee-friendly companies done badly, what would they have said? They would have said, oh, it's just too short term. You're just looking at 3 months. So I find it a little bit uneasy that they've just jumped on the 3-month outperformance in the crisis, and they've said, oh, look, this is sort of proves it. And they're preaching to the converted, and that I would like to believe that, but I think we need to be a bit discerning with the data and not just look at 3 months. So some of the work that I try to draw on has been looking at 28 years rather than 3 months, because it is a short time period. And as my fellow panelists have stressed, right, we want to look at this not being making a quick buck during a downtime, but this being generating a long-term sustainable value and will be relevant for many years to come, even after we're through the other side.
Well, there you go. And we're going to talk about that because Grow the Pie is based on a study of 28 years. So we'll get back to that. Sonia, from your perspective, we speak about the US, the UK, Europe. What about what's happening? You're a huge economy in Brazil. And of course, you're obviously in trying times like we are, by the way. Britain looks downright civilized compared to us right now, even with all your craziness there. So Sonia, how these concepts, is this taking off in Brazil in business? To what extent are you seeing this? Like, Brazil's an enormous country, you can't speak for it, but how much conversation is there about people in Brazil right now in management?
Yeah. A lot of conversation, Bruce, in fact. Of course, there are differences depending on the companies, depending on the regions and so on. But in general, in Brazil, we are talking about the human capital, but I would like to highlight the point that Alex bring about there are several movements that have been occurring lately that are influencing this actual moment, such as Business Roundtable in the US, the BlackRock's letter, the World Economic Forum. So many movements have been occurring lately, and now we are in a moment that all things are more transparent. In Brazil, we are seeing this. For example, we have talking about the investor's perspective, very active GRI in Brazil, a local focal point for GRI in Brazil. GRI in Brazil about transparency. As Amy said, the society is demanding more and more transparency. So we are, of course, we see Europe as more advanced on these, and with US, of course, Europe and US, but Brazil has been doing a good job, in my opinion. Of course, we face so many social problems and economic problems as a country, a developing country, but I'm proud of what we are doing here. And I would like also to emphasize your point, Bruce, about the Morningstar information and how the companies during the COVID are performing better. When you see the sustainability index, for example, around the world. When you compare the sustainability index with the normal index from the stock exchange, for example, we see during the pandemic, all the companies are performing better. So I'm talking about many factors together because the discussion is so interesting. But to answer directly your question, we are paying attention in Brazil to human capital management, to integration about the ESG factors, and the investors are more and more concerned about this. The BlackRock, the CEO of BlackRock in Brazil, for example, made a very good statement about the pandemic moment and about the post-COVID. They said, after the pandemic, the society will demand more responsibility. The business performance standards will change. This event has made it clear the importance of having a long-term look. So we have a local BlackRock leader talking to leaders in Brazil. So I'm also optimistic.
Well, now we're going to get into, again, a little bit more into the weeds. And Amy, I'm just go to the weeds with you a little bit on this. Here's the problem. We just did a pre-taping meeting with two top advertising executives in the United States. I mean, they've handled some of the world's biggest accounts, and we look forward to having them on the show. And they made a really interesting thing about, and it relates to Black Lives Matter. They used Black Lives Matter as an example. And Alex, you know, you're optimistic that there's a lot more talk, and I share that. But I worry that we're kind of in the talk phase, and we haven't yet gotten to the action phase because we don't know what to do. Because here's what these gentlemen said. They said that one of their clients, or they knew of a client that was about ready to spend $31 million on a diversity effort because the CEO had issued a statement that we had to do something, and the company's doing well, and they were going to take $31 million. And then, well, what are you going to do with it? Well, we'll figure. It was they didn't have a strategic and systematic approach. It was, well, we're going to just throw $31 million at it. And these two executives basically said that one of the big lessons coming out of COVID and this chaos is that no, we can't just throw bright, shiny objects at things. So Amy, you know, you get to the great point about scorecards. There's tons of scorecards out there, but what we lack is action. And I would argue that CEOs and these executives said they don't think CEOs know what to do. They think it's going to require a new generation of CEOs who understand the people issue, because they don't think the current crop of CEOs, with some notable exceptions, we could all name them, but that most CEOs, and Alex is training them, so we're going to get back to him on that as well, but that most CEOs don't get it, and that they're clueless. And so if they're clueless, how are we going to get to a strategic and systematic approach? Or do you disagree with that?
There are about 40 questions packed into that one, Bruce, but
all right,
you know,
do they know
I
what
think at the end of the day, you know, some people say we need a new generation of chief human resource officers as well, ones that aren't afraid, ones that believe in accountability, ones that are driving measurement, the right kinds of measurement. I think at the end of the day, disclosure is a very important thing, and maybe building on somewhat of what Alex said, short-term ESG is maybe not the issue. What we are seeing, though, is a tremendous growth in ESG investing and a tremendous growth in the conversation from investors that are putting pressure on CEOs to talk more about their people, to talk more about their people metrics, to talk about how they'll fill skill and capability gaps. So I think I'm a little more optimistic that there will be pressure, outside-in pressure from investors as well as customers for more transparency, for more measurement, for corporate social responsibility reports that actually have some real meat in them, that disclose the things that are critical to investors.
Well, Laura, in your work, and you know, Laura has a very long, or I should say, a successful career in HR, and you've had some pretty, you know, important jobs. And this issue of applying, where does a CEO or where does a CHRO learn the principles of the ISO 30414 standards, for instance, which are simply, you know, forget about ISO. Essentially, the lesson is it's strategic, it's systematic, it's aligned, it's measured, and it's continuously improved. And it always addresses the key audiences that can affect outcomes and aligns them. Those are the basic, you can say that easy. It's like Six Sigma, it's easy to say, but how do you do that? And so if you said to a CEO at the business roundtable, one of those 181 companies, okay, you've now committed to stakeholder capitalism. What does that mean? And I'll bet you most of them would say, well, we're going to spend more money on CSR, corporate social responsibility. Oh, we're going to pay our employees $10 more an hour. Or certainly not that. But I'm going to get to that in a moment with Alex, because he has an interesting perspective on throwing money at these problems. But Laura, in your experience, how many companies that you worked for, I won't put you on the spot, are really that don't just have metrics or scorecards, but the CEO can tell you, like he would have to, or she would have to, in an ISO audit, they would have to tell you what their human capital strategy is, how it's aligned to their business objectives, what are their organizational values and culture, what are they doing to promote it across the entire organization, and how are they measuring that against business performance, et cetera, and what are the key metrics that you measure that against? I'm sorry, Amy, I don't think there's a ton of CEOs that think that way right now, but maybe I'm wrong, and I'm going to give you all a chance to answer that. But starting with you, Laura.
I don't think you're wrong. I think partly it's a structuring issue. The HR departments, or the function of HR, because there are lots of organizations that don't actually even have an HR department, but the function of HR has been viewed more as a necessary evil than as an ally in the creation of value in organizations over time. And I think partly that's because it's fuzzy, it's somewhat amorphous, it can be fraught with all kinds of emotional aspect because people are sort of messy just in general. And they have been somewhat underfunded, particularly from a technology standpoint. And so when you look at the idea of combining data, particularly for smaller or less sophisticated HR organizations, the data that is necessary in order to move through a human capital reporting exercise to create disclosure and transparency in many of these organizations doesn't even exist. There is a payroll function that may or may not actually be an HR function. It may be a finance function, and I would argue there's good reason for it to be a finance function. But because that is the case in many of these organizations, the requirement for understanding, capturing and understanding that data such that you would be able to report it and then combine that information with finance and economics to be able to create transparent and I think utilizable information necessary to make decisions in businesses doesn't necessarily exist across the board. And that's an important precursor to this entire conversation. Then you get to the argument, once we have some of that information, how is it that we use it for the conceptualization of strategy around our business? What is it that this information is telling us that's really important about the way we manage people, the way we operate our business, the intersection between our employees and our customers, for example, and then you create a strategy moving forward. But it requires, I think, a new language of business, which is the language that connects, as Sonia is suggesting, economics and some of these ESG factors in business. And I think to the point that Amy's making, there is the requirement that CHROs, or that responsibility in an organization, understand critically how the business itself creates value in a multi-stakeholder environment, so that those conversations can be had with CEOs, CFOs, chief compliance officers, et cetera.
We're going to have a little more time to talk about that before we close. And I'm going to ask all of you, just to remind you that we want to leave all of our listeners and those who listen afterwards, your key, advice to that CHRO or to that solution provider of what to take to the CEO, how to get the CEO to get it. But Alex, you're training some of the top young executives, and you have for years. Are CEOs learning, or CFOs learning about human capital the way you describe it in Grow the Pie? And so I'm going to let you use that as two questions. One, to share with us, answer that first question about are CEOs prepared, and two, to explain a little bit about Grow the Pie and explain how many CEOs you think get the economics of Grow the Pie.
Yes, thanks. And so here I'm going to temper my prior enthusiasm. So the first question that you asked is do executives sort of get the importance of human capital? And I think they are increasingly recognizing it, but there's a difference between sort of getting it and knowing sort of what to do and how to improve it. So they typically have what I view to be a pie splitting mentality, which is the pie is fixed, let's just give more of the pie to employees. And that could be just by throwing money at the problem. So that was the anecdote that you were just mentioning previously, Bruce. But I think quite a lot of actually caring about employees is not throwing money, but an attitudinal shift. So this might be viewing employees as a key resource rather than just people who execute some tasks. So there was once when I was at Morgan Stanley as a first-year analyst where I was invited to give a presentation to a CFO in front of the global head of investment banking. So that was something which has stayed with me ever since, right? So that is, they didn't throw any money at me, but what they said is, well, you did the research, Alex. I don't care that you're a first-year analyst. You should present this to the client. So things such as the ability to step up, creating a psychologically safe place to work, creating a culture which encourages dissent. There's companies like Intuit and Tata which give awards for failures that ultimately still proved good learnings, even though they were failures. And I think these things are just an attitudinal shift. Do you view your employees as a source of ideas? Are you going to be willing to allow them to fail? And that's something that cannot just be addressed by writing a check. And I think that's where some CEOs and CFOs get things wrong. So it's not just donating parts of the pie. It's actually, can we harness more than what we are currently doing from our human assets? And that's often allowing them to flourish and sort of reducing the amount of management rather than trying to squeeze more out of them as if they were an asset or resource.
So I would, hearing all of this from all of you, it would seem to me we're at the stage now where the awareness is finally there. People, yep, there's an issue, COVID and all these other factors, ESG, but they still don't really know what to do. And that's not an easy problem to solve. So Sonia, from your perspective, what do you think it's going to take to help solve that problem? How are we going to get, because the CEO needs to know what to do. They need to have a solution. And we know that it's going to be strategic and systematic. It's not going to be writing a check of $31 million to something. Or just, you can't just hire Tony Robbins to come in and give a speech and everything's all good, right? So what can a CHRO do or a CFO do to help a CEO find a strategic plan?
Bruce, I think I really enjoyed when you said about the new generation of CEOs and also new generation of HR managers. And I think we need maybe two components, vision and information. So I think we need to support the CEOs with the vision, with the strategic trends. So in this moment, you see some research surveys to give to the CEO a broader perspective about them, and also information, communication. We talked about communication. Sometimes we are talking to CEOs in a different language that the CEOs hear. No, I don't understand. What are you talking about? Let me do business. So I think we need to understand the profile of the CEO, to adapt the language to this profile. Because if you are talking with a very skeptical person, you need to understand it, to change your language to address better the message to the CEOs. I think, first of all, it's like a human thing to understand the profile, to adapt the language, to bring the broader vision and also all the information. But I would like also to bring another component in this discussion, the importance of the board of directors, when the board of directors select the CEO. Because the final responsibility to elect the CEO is the board of directors. So it's also important to have this discussion in this level of the organization. Are the board of directors prepared, selected very good CEO with this vision? Maybe we need to deal with them also.
Well, that makes a lot of sense. Alex, the research that you did for Grow the Pie, it would seem to me that that's important evidence. Um, could you tell us a little bit more about that research and how that can be used to sort of maybe help get the CEO thinking a different way about their organization?
Thank you. So I'll start by looking at the data source. So what I try to look at is the link between employee well-being and long-term stock returns. So how do you measure employee well-being? So what I looked at was the list of the 100 best companies to work for in America. So that list has two main advantages. So one is it was available from 1984. So I had 28 years of data before I ended the study in 2011. So it's not just something which happened over 3 months in a crisis. We've got 28 years of data, and that includes both recessions and booms. So there's some people who think human capital, that's a luxury, we can invest in that when times are good, but now when we need to sort of tighten the belts, we shouldn't. So, but there were recessions in my time period. But the second thing which is interesting is it looked at not only quantitative factors like pay and benefits, but qualitative factors such as trust in management, pride in your job, camaraderie with your colleagues, and those are things that you can't address by just throwing money at the problem. Now, I wanted to look at, are those companies that treat their workers better, do they do better? Now, one of the main challenges is it causation or correlation? Is it employee well-being that leads to better firm performance? Or is it better firm performance, which then leads to companies being able to treat their workers well? And so that's what a lot of the statistical power came into, was to show that it is actually from human capital, from employee well-being, to future performance, which is why Laura's approach of looking at this really material in M&A situations is absolutely justified, right? These are things which are material, but many financial analysts just miss it, and it's not in the stock price, which is why I was finding the long-term outperformance. But then to your earlier questions, Ruth, asking other people, this is why I think we might not want to have someone like Tony Robbins come in, and I know that you only use this baby in jest, but with something which is on human capital, it's easy to say sort of shoot from the hip and say stuff that sounds good, right? Simon Sinek says, oh, let's start with why, or Tony Robbins says some stuff, but actually there is quite a lot of evidence on this. And so what the best companies survey looked at was 5 specific areas. So credibility, respect, fairness, pride, and camaraderie. And so those are the things that the evidence shows is linked with long-term outperformance. And so with something like this, what sounds good is often what people will like to go by. Like the idea of start with why seems really appealing because anybody can come up with why. Whereas if Apple's good performance was because Steve Jobs was a genius who has some great contacts, that's not as appealing. But I think we should go for what the evidence suggests rather than what sort of sounds good and people like to latch onto.
Well, that leads me to our last question that I'm going to go around is to advice for anybody who wants to convince a CEO of the need for a strategic and systematic approach to people. Laura, we had Dave Ulrich on the show last week, and he said something really funny about HR. He said, the problem with HR, he said, they're all about bright, and he's, who knows more about HR than from Dave, from at least an academic standpoint. And he said the trouble with HR is they're always about bright, shiny objects. They're not about talking about the business case. So he really thinks that HR, and I'm going to pick up on what you said and give you a chance to kind of give your advice to anybody who watches this show coming up, and whether they're in HR, marketing, sales, or whatever. What is the business case to make to the CEO, and what's the advice to give that CEO?
So I think raising the conversation beyond strictly human capital and focusing more on intangibles in general, right? I mean, certainly applies to folks in marketing looking at brand and some other components. I would say my advice to all members of leadership, whether they are C-suite members or people that have influence in the organization in some way, is to get extraordinarily curious about the way the business operates, both internally and its value creation internally and externally, looking at the organization through a multi-stakeholder view and understanding how it operates such that from your area of functional expertise and as a member of this community that is working in response to the need to create some level of profitability, because that's what we're talking about for all of these businesses, but also meet the needs of these multiple stakeholders. Getting curious and understanding how these businesses operate, what is it that creates value for each of these communities, so that you can speak the language, as Sonia has very astutely, I think, identified, and to the point that Amy and Alex are both making, can reflect back the things that create that value in a way that is tangible and actionable. And the only way you do that is to understand the business, any business, in a holistic way.
That's a great answer. Sonia, your advice for somebody trying to convince the CEO that it's time to get serious.
Yes.
Not just talk, let's act.
Four factors. First, I would like to refer a survey in Brazil. A very non-consultants in Brazil made a survey about the 10 HR sustainability trends for the next years. Two of them is sustainability approach and sustainability insertion. And so it's necessary to be very concrete in a strategic way. So to put all these things together. Second, to emphasize the link between financial and non-financial performance again, because HR sometimes is on the non-financial part. So how can HR professional translate their information into the financial results, the performance results? Again, we talked a lot about this here. The third thing is bring data. I think data is so important. When you show some data from a very non-academic, very non-newspaper or so on, it's more concrete to the CEO. And third, again, CEO is a human being, just like you and me. So it's necessary to use the emotional intelligence to understand the profile, define the language, and to understand what it will work better for this person that is in front of me. So use the emotional intelligence.
That's also terrific. Thank you. And Amy, it is funny that the HR people don't seem to be, am I wrong, folks? Do you see much folks, HR? I know, Alex, you're not in that world, but I don't see much hacking people talking about this whole thing about human capital analytics and management. So Amy, what would you say to that, to the HR?
One, I think
Are you missing?
A huge movement in human capital and people analytics. It's the highest growth, highest investment area of HR right now. And certainly a lot of the data people have really stepped up to provide solutions. What I would add, though, to the discussion that Sonia and Laura just provided, though, is I think it's very important not only to have the curiosity, but to explore the pain points. Because if you're not exploring the pain points, you're not understanding the priorities of your CEO, of your business leaders, of your stakeholders. And if you explore the pain points and begin to develop data and solutions around the pain points, and that might be spending 70% of your time really understanding the pain points, then I think you can develop solutions. But beware of, the solution seeking a problem. Understand very specifically what those problems are, quantify them. If you can show the decision tree that shows the quantification of the pain and how to solve it, ever the better. So that's I think, my advice is really understand and dig into the pain points, use that empathy in order to drive the impact and actions of your stakeholders, and that's the way to really solve problems.
Thank you. Alex, you're going to have the last word. Your advice to people who are whispering in the ear of the CEO that we've got to move from talk to action.
I think it's just to show the evidence that these things are financially material. So it's not just worthy and fluffy, but it's about the long-term sustainability and success of the business. But I also endorse Sonia's suggestion that we need both the head and the heart. So we need aspirational examples as well. So actually, I've just drawn up the conclusion of my book. So I'll just read out a short extract, which I think aims to combine both the evidence and also the aspiration. When an enterprise is run with the primary purpose of creating value for society, it isn't sacrificing profits and redistributing a fixed pie. Instead, it expands the total value it creates, benefiting investors as well. Indeed, this approach typically ends up more profitable in the long term than an attempt to maximize shareholder value. So it's one that leaders should voluntarily embrace, even in the absence of regulation. The highest quality evidence, not just wishful thinking, reaches this conclusion. To reach the land of profit, follow the road of purpose. Any company or investor that embraces this mentality isn't swimming against the tide or going it alone. They're instead riding on the tailwinds of evidence and joining a much broader movement of peers taking very seriously their responsibility to society. They don't need to put their trust solely in statistics and regression coefficients, but can take guidance and learn from aspirational examples. Leaders of today's companies are in a privileged position as technology and their global reach gives them more power to create social value than arguably ever before. It's up to all of us together to use this power to create a form of capitalism that works for all of society. We have the evidence to back us, the examples to inspire us, and the tools to put it into practice. Let's make this vision a reality.
Wow, I wish I had planned that. Thank you, Alex. What a beautiful conclusion to this show. Sonia, Amy, Laura, Alex, all four of you, thanks so much. This is going to be seen by many, many people for a long time because you folks have covered this issue just beautifully. So thanks so much and have a great weekend. Bye-bye now.
Thanks, Bruce.
Thanks, Bruce. Thanks very much,
Bye-bye.
everybody.
Bye, everyone.
Great.
Thank you.
Thank you.